but I think we can get started. Thank you for joining, everyone. It's really fun to be here today. My name is Lucas, and I'm Product Marketing Manager at Modern Treasury, and we're excited for today's conversation because we're co-hosting with our friends Lithic the session today, and we're excited for it. So Lithic is a program manager and a backend process providing APIs for issuing and managing cards. And Modern Treasury is a unified payment operations platform, which includes bank integrations, payment automations, and a ledger API. So today we'll be talking about mapping your card program's fund flows, or how these two worlds come together. So before we get started and introduce our speakers, I wanted to go through a few housekeeping items. This webinar is being recorded. To the very first question we have in the Q&A right now, we'll share the recording of this webinar once it's done, and we invite you to revisit the content yourself. We'll be talking through some technical things today, and it'd be helpful for you to refer back to it later. We also invite your comments and questions throughout the session. You can use the Q&A box at the Zoom webinar bar on the bottom of your screen. And then if you have questions throughout, just add it in. If the question is pertinent to the conversation at a time, I might chime in and have the speaker answer the question live, or we'll come back to them at the end of the session. So today we have Ali Nielsen, who is a senior technical program manager at Lithic. She does technical integrations between Lithic, banks, and the networks, MasterCard, Visa, and the Fed. Prior to Lithic, Ali was at Galileo, implementing card programs with emphasis on bank and network integrations, which are all tied to ledgering data. We also have Caitlin Swanson, also from the Lithic team. She's an implementations manager, and she guides sports developers as they build and launch their card program, from sandbox development to production testing and program launch, the entire process. And then finally, we have my colleague Sajid Malik, who is the solutions architect here at Modern Treasury. He's a technical specialist who focuses on helping strategic customers build against the Modern Treasury APIs and set of products. So at this time, I'll hand over to Caitlin, who will get us started. And I think the first thing we'll talk about today is why you should have a card program in the first place. So Caitlin, over to you.
Awesome, thanks, Lucas. So I think it's really important to talk about why you should even build a card program in the first place before we get into all of this. So of course, two of the primary reasons are going to be to make money or to solve a problem. But number one that I have listed here, just as a few examples, but revenue. So this may be primary income for your business, and that's the reason that you're building a card program. There's trillions of dollars in card spend every year in the US. So interchange ranges from around 1.15 to about 3.25%. Even though that's split up between different parties that are in the transaction flow, that still means that there's a lot of money to be made by card issuers. Another reason that we want to start a card program is for brand awareness. Maybe it's not your primary source of revenue, but maybe you're doing it for corporate incentive and rewards and to keep your customers or to get more customers. Some people start a card program for data purposes. Maybe it's data to make your own business better. Maybe it's data that you collect and sell or use for other purposes. One of my favorites to talk about is financial education. So say, for example, if you are putting together a card program that deals with budgeting or credit building, some are for supporting underserved communities in the financial sector, and to help customers just learn about credit or learn anything in the financial world. That's one of my favorites. And then also employee spending, to make it easy for your employees to use company funds and to track expenses of those employees. And also money movement. A good example of this one is going to be crypto cards. One of the main problems normally with crypto is that it's hard to spend in real life. If you have a card program that at the time of transaction is able to convert crypto to fiat so your customers can spend, that solves a problem. So those are some of the main ones that I usually see. All right, and then the authorization stream process. So I want to go through an example and just talk about the different steps that happen when you go to a store and swipe your card. So in my example, this is going to be Ali goes to buy a coffee. So let's say that you created a card program and Ali signs up for your card program, goes through KYC, everything looks good. You approve Ali and then you issue her a card. Ali takes that card and she puts $15 into her account with you and takes that card and goes to buy coffee. So the coffee shop, when she swipes the card, they receive the transaction, say the coffee's $5. That transaction is passed through their acquiring terminal to the networks. The networks are going to see that card information and then map it to the processor. where the card is going to be validated. And then your processor is going to take that $5 transaction request and send it to you as the card program, basically asking you, okay, Ali's trying to spend $5. What should we do? So how do you know that the customer has enough money to cover that transaction? You're going to need to check on your ledger and see if Ali has enough money. Well, we know that she put in $15, so we're good to go there. You approve the transaction because she's good for that $5 in her account. And the approval is going to be passed all the way back through those points of the connection. So how do you keep track of money that's spent by the cardholder? You're going to need to change your ledger again because now Ali only has $10 left. And then once that approval gets all the way back to the merchant terminal, it shows that Ali is approved and Ali is able to walk away with her coffee and she's good to go. So just to recap the responsibilities of the card program in this situation specifically, the processor is going to send you an authorization webhook. And when you receive it, your responsibility is going to be to check against your ledger to make sure that you're making the appropriate approve or decline decision based on the customer's balance. Also, your responsibility is going to be to adjust the ledger so that Ali only has $10 to spend now and she can't just keep spending. And then also your responsibility is going to be prepared for different types of transaction scenarios. So maybe a customer is going to go to a different type of store and make a return, or maybe you're going to end up seeing voids or partial clearings, things like that. So you need to be prepared for different types of situations. And all of those are reasons why you need a ledger. So I'm going to pass it on to Sajil.
Thank you, Caitlin. So let's dive into the technical ledgering aspect a bit and take a closer look at what happens during a real-time authorization flow while a card swipe is active. And this part gets into the weeds, but it's quite interesting. So maybe to start, to repaint the picture that Caitlin just described, Ali is looking to buy coffee for $5. She swipes her card. It could be a physical or virtual card. It hits the terminal. The terminal transmits a message to the network, and then the network transmits to the processor. And then the processor asks the ledger whether the $5 should be authorized. And I know that's a long process, but really we're focusing on this final step of asking for permission. And in the real world, that processor who's distributing these real-time notifications, right, these webhooks, may be Lithic, and the ledger running these balance checks may be Modern Treasury. So let's take a look. Let's examine that perspective between Lithic and Modern Treasury ledgers and what really happens behind the scenes during that balance check. So if you zone in on this right side diagram that we put together here, you'll see a simple sort of step-by-step process of the point of asking for permission to the point of approving or denying. So in step one, as a card swipe is happening and the data reaches a processor, the first part is the processor is looking to bundle that data into readable JSON containing a couple of important fields: the amount of the transaction itself, any potential acquirer fee that the merchant may have added to the transaction, and then that sum total authorization amount that needs to be checked. And as you can see here, this is transmitted as a webhook. This is a real-time notification that this event is happening right now. This card swipe is happening right now. So as we drop down to the second step, in the ledger, we want to check that Ali's balance is sufficient for that $5 authorization fee. And in Modern Treasury, the method by which we do that is actually quite unique. We attempt to create a $5 transaction on Ali's ledger account that is quote unquote locked on account balance. This means that in the API call to create a transaction, and all this is happening in real time immediately from the receipt of that real-time webhook, in that API call, we can include a conditional statement saying, write this transaction if and only if the available balance in Ali's account does not drop below zero as a result of this $5 coffee purchase. And what's cool here, the benefit of this is that when you look at step three, those two processes of one, reading that the account balance is sufficient, and secondly, writing that pending transaction to the ledger is atomic. It's all or none. And it's also locked, meaning that we're very thoughtfully handling situations where other transactions may be concurrently affecting Ali's balance between the point of reading the balance and then writing the transaction to the account itself. Now, if you look at the end of step three, let's say the transaction did go through. Ali had $15 in her account and the ledger transaction was created. Our fourth and final step is to respond to that webhook that was initially transmitted at the start of this process and approve that request by sending a 200 back to the original webhook with a result of approved. And what's interesting too, if you look on the other side of the fence, on the right side, if the creation happens to fail, we can also deny the request. And you could deny this generically, send a non-200 API response back to the webhook, or Lithic actually outlines a number of specific reasons you can pass back to that webhook. Maybe insufficient funds, or maybe as part of the webhook, you notice that the POS system or the merchant is one that you don't want to authorize. So you can send back unauthorized merchant. Now, all this must happen within 7 seconds, and preferably much less. When you work with processors, Lithic specifically, often you're recommended to respond within 5 seconds. And if you're not able to respond within those 5 seconds, the transaction that's live will time out and the card swipe will fail. And this brings in an interesting point of latency that's very key in ledger design. So let's kind of talk about that, the importance of a ledger in general and what it really takes to build one. So as we just discussed, having a general ledger is important because it really lets you use data from prior transactions to aggregate balances and then eventually approve or deny live card swipes based on the balance that's being tracked for an individual's user account. So it sort of acts as a general source of truth for all the transactions in your card program. But Ledger's benefits extend beyond just card-oriented use cases. Primarily, it ensures that you can scale your business effectively. Having a central, independent source of truth is important because at the end of the day, every company needs a reliable foundation to track money movement data. And it's important to make that crucial decision early. And once you have built that foundation, you can be confident that you'll prevent money from being, quote unquote, lost or untracked. All transactions between all accounts will be hopefully accounted for. And when you do have a central source of truth, issues are traceable. So, you've created a system, you've ensured that all transactions and balances reflect what's happening in the real world. And now you're empowered to sort of be able to reconstruct a chain of events from transactions that exist on the ledger to later address any inconsistencies, fix errors as they arise. And when you do have, this level of granularity, you can make unique decisions based on how much an account's balance may be shifting at a given time. And really, at the end of the day, the system of checks and balances and detailed logging goes hand in hand with auditability and compliance. Ali will talk about this in depth, but when onboarding an FBO account with a bank, your bank often asks you what your ledgering strategy is. Are you building this in-house? Are you using a third party? Really with the goal to ask a question, essentially, how are you attributing funds for the components of that pooled custodian account? And this gives the bank confidence that you're managing money in a thoughtful way. So finally, okay, let's say you're building a fintech product, you're setting up a card program, or you need some general application financial transaction tracker. How do you actually build that tracker? How do you build a ledger? And really a common theme we see is that companies hope to design their ledger in-house. So we wanted to highlight a few themes and decisions that are important for you to consider if you attempt to undergo this internally. And the first is, how can you ensure scalability? Your ledger ideally should be able to handle a high volume of concurrent transactions appropriately. And on top of that, you should try to ask yourself the question, do you need balances to be immediately or close to immediately consistent? Basically, how do you manage the concept of hot accounts, or accounts that get the bulk of transaction volume where balances are changing within seconds, where when you check the balance at one point, it might have changed by the time you write a transaction to that ledger account. Secondly, flexibility. And what we've learned is that a good principle in designing a ledger database is using primitives like accounts and transactions as the two core objects. And what we really mean by that is a good ledger database ideally doesn't need to have higher order objects like a card object or a cardholder balance object, for instance. That lower level logic makes it easier for you to comply with double entry to flex to any use case and really prepares you for any inevitable change that you might experience in your business model in the future. And finally, should you build double entry or single entry? What we've really learned is that there are immense benefits of going double entry from the get-go, making sure that both the credits and the debits in an individual transaction are accounted for. It's sort of a built-in system for checks and balances, and it dramatically reduces the chance of errors. And it also works into what we talked about before with traceability and auditability. So we've heard stories of fintechs that decided not to go with double entry, later needing to refactor their entire system from scratch. So we highly recommend that you consider these themes. And these are all themes that we took into consideration when building our ledgers product, and are features that you will get out of the box if you work with a partner like Modern Treasury.
Awesome. Thanks, Sajil. So now that we've all identified that I have a coffee addiction, we're going to keep talking about that a little later on. But really, at the end of the day, why does a ledger matter to your bank? Like, what matters to a bank in general? Other than compliance, which banks care a lot about, and they will run you through several hoops, a ledger is really important for your overall card program success, because at the end of the day, it's going to help you understand where money is going and why. Because here's what happens. When we talk about me swiping my card for money, for coffee, and other things, that's data. That's data going back and forth in that process between me as the end card holder all the way to your ledger and back. Changes in that data are happening, but banks don't necessarily see that in the same way. They don't see my transaction versus Caitlin's transaction versus your transaction. They care about it more holistically. So as data and the ledgers are changing up here, they want to see money move around the bottom to support your card program. And how they do that, again, at this holistic level, is by having not just one account, but a plethora of accounts to support this. I'm going to be fully honest. I've seen certain account structures at banks to support card programs as few as 3 to 5 accounts. And I'm going to talk about one of those very simplified models today. But I've also seen complicated ones that help solution architect systems with banks that have been in upwards of 20 plus accounts. It can really get complicated. So we're going to walk through some minor ones today. Again, if you guys have questions, our emails are at the end. I'm more than happy to answer questions tied to this, but let's talk about it. So at your sponsor bank, you've gone through the process of deciding you want to open a card program. You're going to work with a ledgering company or build your own. And now you need to pull it all together to know where money needs to be at the right time. Some of the basic accounts that will be opened is your FBO, which is a for benefit of account, a settlement account, an activity account, a revenue account, which is key for a lot of people, and a negative balance reserve. I'm going to now talk about how all these accounts interact with one another, because you're probably wondering why you need more than just one. So let's start with our FBO. As Sajil mentioned, you'll have to open an FBO for any prepaid or debit model, is what I want to talk about, because this for benefit of is where I, at the beginning of Caitlin's example, am putting my $15 into. Again, the bank doesn't see it necessarily as just Allie's $15. So even though you have these individual ledgers for the cardholder, the bank wants to see it at a holistic level. So let's just go back to the example of I put in $15 into the FBO to support my coffee addiction. Caitlin also puts in $10 to support her coffee addiction, because I'm assuming I'm not the only one on this call. And the FBO then would have a total of $25 sitting in it. That is how the bank is going to see that FBO. Now, an important thing to understand between your ledgering and your FBO is it's available funds. Now, available funds means that whether or not I've transacted, it has cleared and settled with the networks, meaning that the networks, MasterCard, Visa, Discover, et cetera, want their money to pay that merchant, receive their interchange, and diversify the funds. So let's just go back to coffee, because that seems to be the theme of the day. I go and spend $5, and Caitlin's going with me, so she also spends $5. We each have 2 individual $5 transactions. So my personal ledger drops down to $10, and her personal level ledger, which started at 10, goes down to 5. Our FBO is now down to 15, because those $10 now need to be moved to a settlement account so that MasterCard and Visa can be paid. The reason it's important that a settlement account is opened, and sometimes your bank will have one settlement account for all their programs, sometimes it's separate per program, is because it's an identified bank account that the networks are expecting to receive funds from. Funds are settled on a daily basis, Monday through Friday business days, and it's not a negotiation. What they're owed, and they will move forward with that. So that's where money can move from your FBO to your settlement account to help support the actual basic transactions that are taking place on a regular basis. Another account in this structure that's pretty straightforward but very exciting is revenue. If you are receiving that interchange that you've negotiated with your bank and your processor and anyone else involved, where are you going to put that? It can be moved into a revenue account. Another place that money can be moved into a revenue account is, let's just say for some reason your program is helping give me as the end user metrics, and I can pay a fee to know how much money I'm spending on coffee, you can charge that fee to my account. My ledger would then drop based on that $1 fee, and that money could then be moved to your revenue account. Sometimes banks don't open a revenue account. They'll open it as an operating account or an activity account. It all comes down to contractually how you've agreed to utilize that revenue fund with your bank. But again, this is just a basic model. There's a bunch of variations on it. Talking next about an activity account, also known as an operating account, is crucial for your program's success. So other than, me either wiring or ACHing or some other process of getting money in the FBO, there's a lot of things that happen in a card program process that before I entered this industry, I really did not think about. If I think about chargebacks and disputes, where's that money coming from with it being supported by you as the program? Because it costs money to investigate chargebacks and disputes at times. But my favorite example is promotions. All right, so we're going to go back to, I'm one of your favorite card holders and you do a referral. And since I love this program so much, I refer my 5 friends. So since I've done that and I've met the requirements for the referral bonus program and you're running this promotion, you decide to give me $5. So you increase my ledger by $5, but then money actually has to back that up. But where does that money come from to go into the FBO? This is where your bank will care a lot about having an activity or operating account to support promotions, to support chargebacks and disputes, or maybe you're offering loans or cash advances. There has to be an account where these funds are stored. The amount of money that goes into it, again, can be contractually agreed upon between you and that bank, either a certain amount or maybe it's a percentage of the FBO. It varies greatly on the use cases that you are trying to accomplish in your card program. The final account in this, it's pretty straightforward. Banks are risk adverse. They are very risk adverse. So at the end of the day, a negative balance reserve account is a CYA for the bank. If you have to look up what the acronym of CYA is, please be my guest. I don't know if I'm allowed to use the word ass on this, but we're going to send it anyway. It's definitely a cover your ass account. And that's just a requirement. I've never seen a program move forward without a negative balance reserve. And the amount of money that goes in it, again, is contractually based on how risky the bank thinks you are. So once more, I've seen very complicated versions of this. It all really ultimately comes down to what kind of product you're trying to offer. Prepaid and debit are drastically different models prepaid and debit, are drastically different than a credit or a secured credit model, or even a loan model. There's a bunch of different ways that these can happen. But moving on, I will just call out, because I've been doing this for a little bit, working with banks, I hear some of the behind the scenes stories. And ultimately, at the end of the day, my topic is, why does this matter? When it comes to ledgering, if your ledger is off, it can cause so many issues. And one of the biggest ones is your relationship with the bank, specifically for settlement. So when I talked about me spending $5 and Caitlin spending $5 and that being aggregated together to be moved to the networks for them to take their $10, MasterCard and Visa don't negotiate. They tell the bank Monday through Friday, this is what is owed to us. The bank is not allowed to go back to them and say, well, our ledger says otherwise because our card program gave us this data. They pay it without question. It's due at 2 p.m. CST. And if it's not met, fees can occur. And it's a sliding scale for those fees. So if you owe $100 and it's missed, then it's probably not as large a fee versus owing $100 million. It's going to be a lot more money that you're going to be paying out to those networks. And so that is something to pay attention to. The other reason why a ledger and having that accurate data is so crucial is because if you are not tagging those transactions properly, or you're making adjustments to the ledger for promotions, you can just basically lose money. One thing I saw, and to be honest, I've seen examples like this every now and then, and so they don't surprise me for people who aren't being cautious in their ledgering. A card program wanted to offer a promotion. They didn't properly communicate with their bank about it. They didn't properly mark their ledger as these transactions, or not these transactions, but these adjustments to individual balances were taking place for this reason. And suddenly the ledger has a surplus of 200 grand and the FBO did not match it. And the bank is sitting there wondering what's going on with reconciliation. And that card program was not prepared for how popular this promotion was going to be, and then had to come up with the 200K. Doing moves like this can definitely end in your relationship with that bank souring. So just anecdotally in the industry, making sure you keep a healthy relationship with your sponsor bank, have transparency and trust in what's happening with the money moving between those different accounts is crucial. And you can't do that unless you have the in the weeds transactions of what's happening between my coffee addiction, promotions, and all the other different functions that can take place in the card program. So I just want to thank everybody for your time. Again, pass it back to Lucas to close this up.
Thank you, Ellie. We have a handful of questions here in Q&A, and just as a reminder, if you have questions as we're answering those, just feel free to just add them on the Q&A box as well. I think the first one is for you, Ali. And what is the difference between credit, secured credit, debit? You just mentioned that the flows are very different depending on the setup. Can you walk us through the overall, the most important differences?
Yeah, so in prepaid and debit models, the end user is proactively putting money into that FBO. And that way, like, I put $100 in, maybe it's my paycheck, and then I spend down. So the FBO has those funds to begin with. The ledger is checking against the money I've proactively put in or prepaid, and then I'm debiting out. Ultimately, the difference between prepaid and debit is compliance and what's allowed to happen. If you have questions about that, I apologize. I am not compliance. I would talk to your bank. Also, compliance is very tricky, so I have no desire to go into that field. Wish you the best of luck. When it comes to credit or secured credit, they can be a little different. A credit is the opposite. It's I've been investigated and I've been found risky or not risky enough to be given a line of credit, we'll say $150, just to keep math a little different. And so I start at 150, or I start at 0, and I actually work my way down in ledgering. This is where ledgering might be a better question for Sajil on how to manage credit versus debit. But then I would owe the money that I spend. Now, when it comes to a funds flow in a credit model, you might need what's called a debt facility, someone who can float all the money that you are loaning to end users. So that is what credit is. Now, secured credit lands in the middle. It's for users that have not yet necessarily been found safe enough for an actual line of credit. So a secured credit, at least the versions of it that I've seen, because I know there are variations on this, is where it's a debit model where I put my money in, but it's treated like a credit card. So I put $100 in, I spend down on it, but then I have to top it back off to that line. So that way I can build credit. Secured credit is really just a way for people who have none to basically get a practice test run at paying back money to ensure that they can then get an actual line of credit. I hope that answers that question.
Thank you, Ellie. Second question we have here from James. Do I need a CYA or a negative reserve account for a prepaid card program? And can you talk about what are the prepaid card solutions related to this?
I'm not quite sure what you mean by the prepaid solutions tied to this. I will say that yes, a negative reserve account is a requirement from banks. At the end of the day, let's just say you came under fraud attack or something else happens, the bank doesn't want to be out their money. A CYA is really just an agreed upon contractual amount between you and the bank that in case something goes wrong, and to be honest, things do go wrong time to time. I couldn't tell you what percentage of programs have with things go wrong because I've not been involved in that dialogue and conversation, but it really is just protection for that bank. So if you have a very low risk program, probably the amount of funds need to be in that account is going to be very low compared to a high risk program. And I would just make that conversation, open those questions when you've decided what kind of model you want to build with sponsor banks when you're talking to the different ones, because each bank tends to have preferences to what kind of programs they have appetites for, or what kinds of programs they're trying to move into.
Cool. Thank you, Ali. James, let us know if that answers your question. Feel free to type a follow-up in the Q&A if it doesn't. I had a question on the auth stream process. When you think about voids and returns, and this is a question for you, Caitlin, how does all of those like exceptions tie into all of these, the mesh of rules that we're talking about here?
Yeah, so I would say, for example, if instead of Ali buying a coffee, maybe one of your customers of your card program goes to purchase something on Amazon, and then you have an authorization webhook come through to you like normal. You check your ledger, everything looks good, you approve it, and then the item ships to your customer. You receive a clearing message that says that that transaction has cleared, and normally that's how it ends, but there can be follow-ups to that. So if your customer decides to return that item, when Amazon gets that item back, you're going to receive another webhook with a type of return, just so that you can update your ledger on your side as well. It works really similarly for voids too, except for when that happens, it's before the clearing happens. So that would be if your customer purchased that same item on Amazon, you approved it, and then they decided to change their mind and cancel that item before it ships, then you could get a void message come through. You can adjust your ledger once again and go from there. So they don't also have to be all or nothing, I feel is an important thing to talk about too. So your customer can place an order for 3 items on Amazon. One of them can ship, and then that gets a partial clearing. And then the other 2 are still in the authorized state. So you're adjusting your ledger for just that one. And then the second ships, you get another partial clearing message. And the same thing goes for partial returns, partial voids of a transaction as well.
So, so many of these use cases are real time, and the speed of information transfer is of the utmost importance. So I wanted to ask you, Sajil, what's your experience in terms of like the technical benchmarks that your ledger needs to meet from like a latency, availability, throughput standpoint, and how can you design something that works well for that use case?
Right, right. That's a very good question. Performance really, when you're thinking about higher volume transactions, or you're thinking about what we're talking about now in the card space, needing a very quick latency to respond to a real-time authorization request, performance and availability really is the name of the game. So a few questions that usually arise are around throughput. How many API calls can you handle and how quickly? Latency, meaning how long does it take API calls to actually resolve? And another important concept is uptime and availability. For how long is your API actually up? Can you be confident there won't be downtime during these high velocity and high volume API calls? So from the Modern Treasury perspective, I can actually answer this. From a throughput perspective, we attempt to keep our production API rate limit at 100 requests per second, which should be satisfactory for situations where, maybe you have an application that has a dashboard for each user and you need to showcase balances very quickly, where multiple users may be updating and looking at their dashboard at the same time. You can run as many GET requests as you'd like to us within that 100 requests per second rate limit. From a latency perspective, as we mentioned in the auth stream process, you have at most 5 seconds to respond to a real-time authorization request. So from a Modern Treasury perspective, our P90 statistic latency is 35 milliseconds for reads and 70 milliseconds for writes, which means that 90% of our API calls have a response time within that time frame. So you should be very confident that if you're writing a transaction to Ali's ledger, for example, within that time span, you'll be able to respond within 5 seconds to either authorize or deny that live card transaction. And uptime, availability are also very important metrics. Ideally, you have a ledger that is at least 3 nines and is up for 99.9% of the time. For Modern Treasury, you can actually see this actively if you go to status.moderntreasury.com. For ledgers, I believe our availability is around 99.97%, and we strive to keep that consistent so that you can really be confident that we're maintaining infrastructure to keep this latency, to make sure that we can respond to API requests quickly and to allow you to test and consistently improve your use case.
Cool. Thank you, Sajil. So we just walked through a lot today. Thank you guys for joining. I guess as a closing question, and we do have a list of resources here, for you folks, I just wanted to go around, and I'll start with you, Ali. It could be something that's on this list, it could be something that's not on this list, but what has been a good resource that you found helpful if folks want to learn more about any of these topics?
I would definitely recommend The Anatomy of a Swipe. It's something that I've worked at 2 backend processors now, and both of them gave this book as part of the onboarding process. It's a super fantastic combination of like high level, what happens in this industry, intermixed with like user experience. And when I read it, I'd already been in the industry for a while, and I found a lot of it very accurate. Not that I didn't find anything inaccurate, it was more of, I was able to relate to a lot of it.
Cool. How about you, Caitlin?
I would say another good one is, I actually have it in my desk, the Field Guide to Global Payments. This one is a really handy one if you are wanting to kind of like dive in a little bit more. But there's another one, what is it? Payment systems in the US, that's a bit like longer and more in depth. If you want to like start with something before that, I would definitely recommend this one.
Cool.
Do you just keep it on your desk at all times for reference?
Yeah.
No.
That's a great book. And then for you, Sajil?
Actually, what I was going to mention is listed here as number 3, written by you, Lucas, Accounting for Developers, which is a honestly really bite-sized, digestible breakdown of what it takes to design a ledger, and what you should think if you are an engineer or developer building a product that needs to record money movement. And I believe there are 3 parts now, if I'm not mistaken. So yeah, stay tuned. You'll be in for a nice ride.
There's related to that, actually, there is a question here that just came in. You mentioned to abstract your ledger down to core objects. It was accounts and transactions that you mentioned, Sajil. Serge is asking for us to kind of list them out again in a quick bite. And one thing I'll say, Sergio, is that there's content that we're going to be putting out on this soon, but one of the articles that speak about this is the 4th one here in this list, How and Why Homegrown Ledgers Break. But I don't know if you have anything to add there, Sajil.
Yeah, Sergio, actually one piece that might be worthwhile to read, and I can see if I can pull it up now and share this in the chat. But in our documentation on Modern Treasury, we have a number of guides pertaining to ledgers, one of which is very specific to this question, ledgers objects. And so you can see how we've designed our ledger to have 4 core objects and 1 object for aggregations. And that includes a ledger itself, the ledger accounts in a ledger, the ledger transactions between accounts, and the individual entries within a transaction. And then we have this concept of categories that allow you to aggregate the balances in multiple accounts together. And I'm pulling this up right now, and so you can read this on your own time, and that might be helpful in really thinking about these sort of primitive ledger design decisions. Give me 1 second.
I think what we can also do, and Lithic team, keep me true to the premise here, but we can also share a list of these resources and the list of books on our follow-up email. Cool. Thank you so much for joining us today. This was a joy. Hope to do more collabs like this in the future. And stay tuned for the follow-up email. If you have any questions to us, just reach out. We're open to answer any questions you guys may have. Thank you all.
Thanks.